Welcome, everyone, to the Nichols and Redpath Tax Update Podcast for October 17th, 2022. I'm Lynn Nichols. My partner, Ian Redpath, will certainly join us next week. I'll get the technology figured out. This program is produced to provide current information about developments in United States tax law. Hot topics, right? Our commentary is necessarily brief, and we acknowledge the value, in Ian's case, of his subscription to Checkpoint, published by Thomson Reuters, and in my case, my subscription to Tax Notes Today. Each of those subscription services provides valuable information to us in our practice and in the preparation of this program. What's in the program this week? 9 items. You lose privilege with a dual purpose communication, maybe, and the IRS pursues a claim for deficiency because the transaction had no meaningful purpose. That's an interesting and an old argument, right? S corporations are no longer required to seek letter rulings to correct late elections, mistakes in documents, and that also applies to limited liability companies, and that is big news. Next, a fact sheet, which offers guidance on tip reporting compliance. That's old news. Need to prepare for a flood of Forms 1099-K, folks. I think we're going to see a lot of those. Our clients are not going to know what to do with them. We need to be prepared to explain to our clients that it's likely that the IRS will track the amount of income reported on Forms 1099-K, and that is probably going to have something to do with their expectation of income reported on your Form 1040. Final regulations correct the Affordable Care eligibility so family members can get coverage under the Affordable Care Act based on the income of the employee, not just the employee getting coverage, but also the family members of that employee. The IRS has updated reporting of uncertain tax positions. That's the schedule UTP, which only applies to large corporations with lots of assets and other complexities, but still, there are many of you who have at least one such client. And then the bankruptcy court allows the IRS to collect a tax debt. Well, wait a minute. I thought that when you filed for bankruptcy and you're discharged in bankruptcy, that it's over, that the IRS cannot come back to collect anything else, but I was mistaken. And finally, an accounting firm loses its own tax dispute because apparently they did not completely and properly understand the rules for maintaining partnership capital accounts that are contained in the regulations. That's a big agenda. Let's get to it. With regard to grand jury, a case docketed in the Supreme Court, we expect to hear from them this term. Conflict among the circuit courts. In the Seventh Circuit, a dual purpose document that gives business advice and legal advice cannot be privileged because of the presence of something other than legal advice in the document. The Supreme Court refused to hear an appeal in the case of Frederick. In the Court of Appeals for the DC Circuit and the Ninth Circuit, a dual purpose document can be protected by attorney-client privilege when legal advice is a significant purpose, even if it's not the primary purpose. And Judge Kavanaugh participated in that decision in the Court of Appeals for DC. So whether you could take some clue from what Judge Kavanaugh might do, but this case is important, I think, to CPAs who serve business clients. We provide tax advice, we provide tax compliance, and very often, because we are trusted advisors, we provide business advice. It's important if you want to maintain the protection of Code Section 7525 that the IRS cannot discover what your tax advice to the client is. You want to give tax advice in a separate communication from any business advice. Business advice would be, I think the location A offers the best possibilities for sales, and we get involved in a lot of things like that are really have nothing to do with tax advice. You don't want to produce a hybrid document. Why test it if you don't have to? Tax result is denied because there's no meaningful purpose. Deloitte came to its client and said, listen, we have found a loophole And if you will do the dance with all the proper steps, we can save you the tax on $2.4 billion with a B. So Liberty Global bought the deal from Deloitte. They engaged in a series of transactions, which Deloitte called Project Soy, whose sole purpose was to avoid tax on the transfer of its interest in a Belgian subsidiary. And that was, we'll call it TGH for the purpose of this analysis. TGH's earnings and profits would not have been sufficient to shelter the $2.4 billion transfer gain, so other unnecessary steps were inserted in order to pull the earnings and profits of other entities into TGH. Those steps involved another Belgian corporation owned by TGH, a disregarded entity, in turn owned a disregarded Luxembourg corporation, which it was a limited liability company, a financing arm, a very confused transaction. The IRS says, look, that transaction served no meaningful purpose. No meaningful purpose. Over 2 days, the Telnet Group eliminated billions in capital. They engaged in a series of transactions. But apart from the tax effects, those steps didn't meaningfully change Liberty Global's economic position, had no substantial purpose. The IRS, I believe, correctly asserts, I believe, in my opinion, that Project Soy's tax benefits should be set aside under either the economic substance doctrine, which is now codified, by the way, in Code Section 77010, the business purpose doctrine, which remains a judicial doctrine, the step transaction doctrine, which remains a judicial doctrine, or the substance over form doctrine. So there's one statutory rule and 3 judicial doctrines, any one of which should bar the benefit of Project Soy. And I've got a little green note at the bottom here. This litigation also includes the validity of regulations published by the IRS without complying with the Administrative Procedures Act. You're going to hear a lot about that from people that I'm sorry, a lot of people that don't know what they're talking about are going to choose to try to talk about that. I think it's a tempest in a teapot, personally. I think most of the regulations promulgated by the Internal Revenue Service will hold up, even though they didn't follow the Administrative Procedures Act, because those particular regulations were not required to be issued after following the Administrative Procedures Act. Do it yourself. Letter ruling is no longer required for simple fixes. This is big news. Revenue Procedure 2022-19 provides taxpayer assistance procedures in 6 areas, allowing an S corporation and their shareholders to resolve frequently encountered issues with certainty and without requesting a letter ruling and without spending the money for a letter ruling, by the way. A transition rule effective October 11th is provided for pending letter ruling requests. And then on October 12th, the IRS clarified in an announcement that the self-help remedy for retroactively fixing invalid S corporation elections will also apply to limited liability companies where the LLC fails to modify its operating agreement so that it doesn't contain conditions that would immediately terminate an S election. This is a big change. It's something we've been concerned about for decades. The IRS finally got tired of dealing with the requests for revenue ruling. Taxpayers thought it was unjust to penalize them for their carelessness anyway. These are the 6 areas that are resolvable without a letter ruling. The 1 class of stock requirement, including principal purpose conditions, the disproportionate distributions, some inadvertent errors or omissions, foot faults, right? Missing administrative acceptance letters for an S election, federal income tax return filings that are inconsistent with an S election or a Q sub election, and potential retroactive corrections of non-identical governing provisions. That would be where you had 2 issues of stock that subject to governing provisions that were not identical. So you thought you had only one issue, but turns out you had two. It's easy to fix. Do it yourself. No longer required to get a letter ruling. Tipped employees and employers. This is waitress Sally. Fact sheet guidance reminds taxpayers who work in customer service industry that tips are taxable income, provides information about the definition and different types of tips, explains how to record them and report them, both to employers, employees, and the IRS, explains the requirements for employers with tipped employees, and answers the question, what are tips? How do you report tips to the employer? How do you report tips on your individual income tax return? And the answer, of course, is you include a Form 4137 if the tips are not reported on a Form W-2, and the requirements for employers to help with the record keeping. Be prepared for more Forms 1099-K. The American Rescue Plan Act of 2021 lowered the threshold. We're going to get potentially tens of millions of new 1099-Ks. The $20,000 200 transaction threshold was replaced with just a $600 threshold, $600 of transactions with no number of transactions threshold. That lowers the bar so that people that are selling stuff on eBay are going to get a 1099-K for $700 or $800, and other specifically internet activity. What to do? Good question. Start now. Alert your clients who engage in direct sales or who transfer money to family members. They're going to need good records to prove the source of funds and avoid taxable income, because the IRS will calculate the gross amount of Forms 1099-K received by a taxpayer as taxable income. And you're going to have to support that it is not taxable income. Or if it's sales, you better keep track of your cost of sales. There's the form, the 1099-K. And here's a poor, overworked accountant who is just covered up in Forms 1099-K. It's going to be filed by payment card and third-party network transactions for the most part. There's all the information that is required, and you may not have paid any attention to the Forms 1099-K, or maybe you didn't have a client that got one, but you're going to have it now. Be prepared. Start now. Alert your clients to what they need to do to take care of the 1099-K when they receive it. And some clients will receive a dozen Forms 1099-K. Easier to access the premium tax credit for family members. These regulations, Treasury Decision 9968, final regulations regarding the eligibility for the premium tax credit provide that affordability of employer-sponsored minimum essential coverage for family members of an employee is determined based on the employee's share of the cost of covering the employee and those family members, rather than simply the cost of covering only the employee. The IRS says that's a better reading of the relevant statutes. It's consistent with congressional intent, which was to cover as many people under subsidized health care as they could. The final regulations also add a minimum value rule for family members of employees based on the benefits provided to the family members. It's a break for family members of, for families that are in the income level that's enjoying the premium tax credit. This is a break. Got an uncertain tax position? Be sure to tell the Internal Revenue Service. On October the 11th, the IRS announces that qualifying corporate taxpayers will be required to report incremental amounts associated with each uncertain tax position taken in the 2022 tax year. That's incremental amounts, right? The form adds 5 items to be reported for each position. Taxpayers must identify any revenue ruling, revenue procedure, letter ruling, advice, anything that is contrary to their position. And if the position is contrary to a Treasury regulation, you have to identify the regulation. So that brings the Schedule UTP into conformity with the Form 8275. And finally, the final 3 columns on this draft Schedule UTP require taxpayers to identify the location of the tax position by form or schedule and by line number, and to tell the IRS the incremental amount included on that line that relates to the position taken. No secrets. Bankruptcy may not stop the Internal Revenue Service. Meyer Paul Schwartz was a big earner, $350,000 a year of income, didn't pay his income taxes, filed for bankruptcy, submitted a plan of reorganization. The IRS, in order to allow the plan of reorganization to go forward and the taxpayer to restart his business affairs, the IRS agreed to take less than the amount of income taxes Mr. Schwartz actually owned. And that was what they agreed to take as a participant in the plan of reorganization. So they participated they approved the plan, the debtor paid the full amount due the IRS under the plan, and then the next week, the IRS claims they filed to collect the rest. Well, wait a minute. Well, wasn't the plan for the full amount of tax owing? What? No, that's right. The IRS's participation in the debtor's fulfillment of the terms of a confirmed plan of reorganization do not preclude the IRS from pursuing the remaining balance after discharge. The plan's full and complete satisfaction language is just that. The IRS, the debtor, has paid full and complete satisfaction of the obligations agreed to under the plan of reorganization. That language relates to the IRS's claim under the plan, not the dischargeability of the entire tax debt. The lesson here, be very careful about your assumptions. You've got a high income taxpayer that owes the IRS a lot of money. You're probably not, you may reorganize, you may get the IRS off your back during the term of making the payments under the plan, but you're not going to avoid paying the full income tax liability that's due. Okay, this is it. Accounting firm's calculation and allocation of income was correct, but that's not the end of the story. They carefully negotiated an agreement for withdrawal, valuation of client accounts, and allocation of income, and in a generally favorable decision, the tax court said the partnership distributed client-based intangible assets to partners when they withdrew, and the assets so distributed are properly valued under the terms of the partnership agreement. So far, it looks good. However, the partnership failed to maintain capital accounts in accordance with Treasury Regulation 1.704-1B2, small Roman numeral 4. Therefore, the special allocation, the CRC, that's the accounting firm, special allocations of income lacked substantial economic effect. Their distributions were properly valued, but the special allocations of income lacked substantial economic effect, and the IRS requires reallocation of income in accordance with the partner's interest in the partnership under Code Section 704B. Okay, what is substantial economic effect, and how do we determine the partner's interest in the partnership? The special allocations lack substantial economic effect. What does it say anyway? Plain English. Increases are to be based, and here we're talking about substantial economic effect of the partner's capital accounts, not basis, the partner's capital accounts. The increases are going to be based on cash in, the fair market value of property in, and allocation of income and gains for the operation of the partnership. Decreases are going to be based on money out, the fair market value of property out, and it's that fair market value. That's where you're accounting for a capital account with fair market value in and out differs from accounting for basis, which is the basis of property in and out. Anyway, so you're allocated non-deductible expenditures, you get an allocation of losses and deductions. The words are easy, but operating the partnership can get complicated, which it did in the case of CRC. Substantial economic effect is present only when the result of a transaction that increases one partner's capital account can be expected to decrease the capital account of another partner. that substantial economic effect. So we got that. Now, how do we determine the partner's interest in the partnership? Code section 704B and the related regulation gives us this hint. In determining a partner's interest in the partnership, these factors are among those, and this is not an exclusive list, that will be considered: the partner's relative contribution to the partnership, the interest of the partners in economic profits and losses, the interest of the partners in cash flow, and the rights of the partners to distributions. Those are 4 of the considerations in determining a partner's interest in the partnership, but that's not an exclusive list. And frankly, I would rather not be trying to figure out a partner's interest in a partnership because the partnership failed to maintain proper capital accounts. Make sense? Let's go to our last and final slide. Until next week, thank you for your attention. I'm Len Nichols. You're also going to meet Ian J. Redpath, my new partner in crime, working for the South Carolina Association of CPAs, probably next week.